Hello, my name is Steve Truglier with Bloom Shapiro, and this is our continuing Bloom Talk series on the new Revenue Recognition Guidance, ASU 2014-09, effective for non-public companies with periods beginning after December 15th, 2018. Today we are going to be going through two topics and understanding the changes with the new standard to significant inefficiencies and contract costs, how the changes to these two topics are going to impact contractors, and what actions contractors should be taking now. This slide has all of my contact information, so please feel free to reach out with any questions that you may have, and let's get into significant efficiencies. We'll start with significant inefficiencies. As we know, in many construction jobs, there is some level of expected waste that is unavoidable and part of the contract. However, the new standard is looking specifically at instances where an entity experiences significant unexpected levels of wasted labor, resources, or material. These are considered your significant inefficiencies. Now, determining which costs represent unexpected wasted materials, labor, or resources is going to require significant judgment. And again, this should be considered on a contract-by-contract basis when determining materiality. Below is an excerpt from the standard, but it essentially is stating when you have these significant inefficiencies, they should not be factored into the costs incurred, and thus no revenue should be recognized because of them. Instead, these costs should be expensed with no impact on revenue. Examples of these types of inefficiencies would be extended labor strikes, design or construction execution errors like installing the wrong material, or ordering the wrong material and not being able to be refunded. Pretty much anything that results in significant wasted resources is going to be considered here. Remember, the key word is significant, and if you deem something not to be significant to a contract and you don't want to have this accounting done for it, you have to be prepared to support your position as to why. Another special consideration under the new revenue recognition standard is the handling of contract costs. These are incremental costs in obtaining a contract, and under the new standard must be capitalized if the contract period is greater than 1 year. Conversely, contract costs that would have been incurred regardless of whether the contract was obtained, such as a bid cost to file the paperwork, would not be capitalized and would be expensed and would not be part of this. However, direct costs of fulfilling a contract are capitalized under the new standard if not within the scope of other standards and if they meet the following criteria. They relate directly to the contract, they relate to future performance, and are expected to be recovered under the contract. Some examples of these types of costs would be sales and commissions that are dependent on the actual awarding of the contract. So if you have a sales rep and they sell a contract and you pay them X amount of dollars and the contract lasts longer than a year, assuming your commissions are material to the contract, that would be capitalized. Some of the other ones we're seeing are bonding costs if they're significant for jobs. And again, these costs should all be combined into one number. So if you have sales commissions and bonding costs, the combined amount is your amount that you need to identify if that number is significant and material to the contract. It is also important to note that these capitalized costs are amortized as control of the goods or services to which the assets related to is transferred to the customer. And if this time frame is expected to be less than 1 year, then the costs may be expensed rather than capitalized. There's no specific guidelines making you capitalize them if the contract doesn't span more than a year. Lastly, if these costs are not considered material on a contract-by-contract basis, they do not need to be capitalized. So there's no sense in capitalizing $5,000 in commissions on a $10 million project. Hopefully you found these two topics interesting and useful. And on the last slide, if you have any other questions at all, please feel free to reach me at my email on this slide, and be sure to check out other revenue recognition resources and articles on Bloom's website in the link below.